This is the Daily Market Rundown live from the Tradelo trading floor. It's March the 11th. Some highlights from today's show. Recession fears are overblown. It's turnaround Tuesday, and Jolts data is now in focus. Good day traders, and welcome to another daily market rundown. Let's get stuck straight into it. Yesterday was the capitulation day. It's very important that we term it as that because it's going to ultimately define what to expect today. Now in a few moments what I'm going to do is take you through a couple of pattern plays you can expect to see, particularly in the risk markets. But for now, let's get stuck into our first topic discussion, which is recession fears are somewhat overblown. So what we need to do is we actually just need to take a little bit of a rewind and think about what ultimately happened over the course of the last 3 weeks that everyone is now suddenly using that R word, that big R, recession word. Well, in reality, it actually started with the PMI manufacturing data that came in very, very poor back in February. But ultimately, a large part of this uncertainty or this recession is being driven by this idea that tariffs create uncertainty, companies don't want to invest when they're uncertain, and therefore we're going to see the US economy drop off of a cliff. Now, what we have to do is just take a very, very big step back and think to ourselves, what actually has Trump done against what he said he would do in his election promises? Well, he told us he would be putting tariffs on many countries, and more importantly, if we look at the tariffs that actually have been imposed versus what he told us in the election campaign, it's not nearly as severe. Okay, so I think markets are getting very much ahead of themselves. I think a narrative is being formed here that we're running into some form of a recession, when in reality what's actually happening is we're just running into a little bit of a slowdown on the expectations. Now I'm also going to show you a chart of US expected growth, long-term growth expectations, to make sure that we define the difference between a slowdown in growth and a recession. They are two very, very different things, and the market pricing of them will be very, very different. Okay. For now, let's just have a look at yesterday, because I think there's a number of things to pay attention to. We all know that it was a significant sell-off, but what I want to lean on is this idea that right now we have dropped 8%. Okay, if we look at the course of the last 13, 14 trading sessions, we've dropped a significant amount in a very short space of time. And that's important, not because all of a sudden we're going to turn around and rip up the page, but because markets just don't move in straight lines. We'll discuss that in a moment. Key, of course, NASDAQ has now entered a correction that did start, of course, when we started to get the DeepSeek news. And then importantly, the S&P in terms of price earnings gauge, whilst it's come off a lot, it's still relatively elevated at historical levels. So some people use the PE as an idea of, when is there good value or fair value to start buying the S&P 500. As well as, I think there was an important release yesterday from Delta Airlines. They actually came out and revised down their Q1 earnings expectations. And that matters because Delta is seen ultimately as a proxy of consumer spending. Okay, when some consumers are feeling wealthy, when they're feeling like times are good, they're typically going to spend more on flights. Why? Because they'll take more vacations, and they'll be more inclined just to take those, sort of sporadic trips here and there. So the fact that we're seeing that pullback, where a lot of consumers are now saying, well, hang on a sec, let's reconsider, let's cancel, let's not take those extra additional vacations, does point not necessarily to a recession, but to a continued slowdown in consumer demand. Okay, but this is not new. This is not something that came out of the blue. This is something that already started late last year when we started to see credit card, balances tick up. We started to see delinquencies tick up. The consumer slowdown is not new. It's just something that is now coming to the attention, given the R word is being thrown around. Okay, the key from yesterday: NASDAQ down 4%, S&P down 2.7%. And this comes after, and we'll share this chart in a minute, this comes after an already big sell-off in a very short space of time. This matters contextually. Why? Because in a minute, I'll show you what the pattern play is for today. But what I want to just point out to, there's a couple of more things you can go and read through. The key takeaway right now is that the market is pricing in some degree of a slowdown, not a recession, a slowdown, and that's because of the uncertainty. Okay, so what that means is, should we get some certainty? Should we get a Donald Trump coming out and saying, look, this is what he's going to do in terms of tariffs with Mexico and Canada. This is what he's going to do with China. This is what he's going to do with Europe. The moment we get those tariffs, what you'll actually see is a sort of sell the rumor, buy the fact, where the market says, well, hang on a sec, actually, 30% tariffs on China, that's not so bad. We all understand the lay of the land now. We understand what to expect. Therefore, we can get back to business as usual. Okay, so when we do get that confirmation of the tariffs, at some point what you're going to see is the market's going to digest it, accept it, and then we'll be back towards more normalized type trading. Okay, it's the uncertainty that's just creating a little bit of the volatility in the markets currently. Now, one other thing to point out, of the weekend, Trump had an interview, and he didn't confirm or deny a slowdown or a recession. In essence, it's this sort of continued narrative, and it started last week already. That's why it's not new. It started last week, where the administration is now saying they'll accept short-term slowdown in terms of the big picture, which they think is going to be an acceleration of the US economy. Okay, so they're accepting a little bit of short-term pain. Now, short-term pain does not mean Donald Trump will accept a recession. Okay, if you were around in his first term, he stuck his whole candidacy, his whole presidency against this idea that the stock market's hitting record highs. I even remember when he came with the 10,000 Dow and he put the cap on the red hat that said, look, record highs. He tied his entire presidency to the stock market performance. Okay, so it's no different now. He may be saying in the headlines he's not even looking at it. That's absolute rubbish. Of course he's looking at it. Why? Because if the stock market does correct too far, the economy will go into recession. And the last thing Trump wants is a recession. Because why? How's he going to get the US economy out of a recession? He's going to have to spend more. More fiscal spending means yields go back up higher. Yields go back up higher. How is the US government going to finance itself later on this year with higher yields? Okay, he does not want a recession. He does want to manufacture. Again, I need to be careful here. He doesn't want to manufacture a slowdown. He doesn't mind a slowdown because it'll bring yields lower as demand comes lower. Okay, that's important to stress that. He doesn't want a recession. He will do anything to avoid a recession, as will Powell. Okay? Keep that in mind. With the slowdown, that does bring the Fed into play. It does mean the Fed can perhaps cut a little bit more this year than currently expected. Now let's get on to the charts, because I think there's some key takeaways here. This pattern play, what you can see in the yellow is the S&P 500, and then you got 4 lines. It's 20-day, 50-day, 100-day, 200-day. Now, it's important you look at this type of chart because you'll learn certain patterns within the market. Now, the first pattern to note is that we are very much in an uptrend. The uptrend has not destroyed itself. The uptrend is still firmly intact, and we are now in a corrective type pattern. Now, in order for this corrective pattern to continue, you're actually going to have to see some hard data come in and say, we are seeing a significant slowdown. Now, don't tell me the Atlanta GDP forecast is your data you're leaning on, because it's very, very heavily influenced by the current bringing forward of imports that's happening in the US economy. Okay, if you go look at the effective Atlanta GDP forecast without the impact of imports and gold, you'll see that, yes, they are forecasting slower than expected growth, but it's still a positive, I think, 0.5% GDP for Q1. Okay, so not negative, not even close to negative. Okay, so you've got to get this idea of a recession out of your head. That is just the Twitterati trying to drive a narrative. However, if we were going to get a recession, I can bet you right now, or I can guarantee you, you're not going to see such a wonderful little concentrated, sell-off where the market just moves lower in a measured way. Okay, you will see a far more aggressive sell-off in the market, and we're talking about 20, 30, 40% correction here, not an 8% correction after, like I said, the market has already rallied, or it's still already 56% higher than where it was October 22. Okay, this is just another correction in the market. Now, what we need to understand is how the market corrects, because that's why I'm showing you this chart. Typically speaking, what happens when you get such a quick reversal like we've seen over the course of the last couple of sessions? There you can see it. We're down in 13 sessions, 8.5%. That is quite dramatic. Moreover, we've blasted through all the moving averages. Okay, now very important. I'm going to show you another chart in a minute that'll show you how to trade this. But when you plunge through all the moving averages like this, typically what happens is the market goes from being overbought to oversold. And what should happen now is the market should make its way back up towards that 200-day moving average, even perhaps a little bit higher. Okay, a little bit of a squeeze, a little bit of consolidation type pattern, similar to what we got in the last two corrections in 2018, 2020. What does it look like? Note 2018. Okay, this was a slowdown led by the stock market, led by a 20% correction in the Nasdaq. Ding, ding, ding. Sound familiar? Nasdaq's down 10%, so very, very similar context. Note the market had a very aggressive sell-off, retraced its way. First there sells off below the 200-day moving average, bounces back, and then continues. Okay, so I'm expecting something very similar here, where we've extended through the 200-day, we trade back up towards that moving day average, and then we can continue to sell off if the economic data justifies it. Okay, if we look at COVID, this is the COVID era. Same thing. And remember, COVID, all bets were off. No one knew it was going to happen. The world was going to end. Uncertainty was at an absolute extreme. This is not even close to tariffs. Tariffs are not that uncertain. Look what happened in COVID. Sold off very aggressively, straight line. What did the market do? It pivoted and it traded around the 200 moving average for almost 2-3 weeks. Okay, and then the uncertainty heightened because the world was going to end, and then we got that extension. Okay, so very, very important. If I go back to that chart, just note the pattern here. We've done the first move. The first leg is lower. It's done. We're below the 200 moving average. I expect a very, very decent bounce incoming on turnaround Tuesday. Starting today, we saw a little bit of that buy side come back in the overnight. I expect a little bit of a rebound today, tomorrow, the rest of the week. And then perhaps if that data does start to come in weaker towards the middle and the end of this month, then fine. Maybe we do extend this. Maybe the correction's got a lot more in it. Maybe it doesn't. Who knows? Okay, the important thing is we'll trade what we see, and right now we've got a short-term bounce in play. Now, in terms of the pattern play, yesterday was a liquidation pattern. What do we mean by liquidation? Well, when you see the S&P down as much as it was, 2.7%, and you see the Nasdaq down 4%, effectively that tells us and signals to us it's the liquidation where people are not concerned so much about price. They just want to exit the risk. Okay, so what's happened over the course of the last couple of sessions? We had a bit of a sell-off. We had some early sellers that enter the market, and then finally yesterday we had the capitulation play. Okay, it looks like a trend day. It looks like sellers on control all day. But it's not a trend day in the sense that people are entering fresh shorts. It's a trend day because longs are liquidating their positions. And that's why we get the final flush lower on very high volume. It looks like a trend day. Now, one of two plays happened today. One, what we do is we get a straight reversal of yesterday's session. Okay, so we get an equal and opposite play and we trade back up towards yesterday's highs. Should we get that play, that defines a very nice bottom for us, effectively a bottom that should hold for a number of days and perhaps weeks. And then we should have a little bit of a rebound, a little bit of a rally, squeeze of some of the very aggressive shorts until we can find that liquidity, that sell side liquidity in the market. Okay, now, will that sell side liquidity be there? We don't know. Okay, we just do not know. They are big institutions. They understand the situation a lot better. They've got their models on in terms of if we are in a recession or not. Right now, the probability of recession has been priced to around 20 to 25%, and it's in the price. So to get prices moving lower, you need more data to come in to confirm whether or not we are going to be in a recession. Okay, as of today, there simply isn't really any data in the near term that is going to justify this current move in the markets. Okay, we'll talk about Jolts in a minute because that does have the potential, but we'll get to that towards the end of the stream. Okay, the second type of pattern you can see is effectively where if I just draw yesterday's profile for you, what we do is over the next couple of sessions, we do this sort of scrape higher pattern. Now, this is not as strong as the first pattern. It's not as bullish as the first pattern. And in actual fact, if we get this sort of a rounding type bottom, it's highly likely we are going to go and retest yesterday's lows at some point, perhaps much later this week or even next week. Okay, the point is today is not a day to be aggressively shorting the market. It is very much a day to look to buy into any kind of selling and look for that little bit of an extension. And again, depending on what pattern play we get today will ultimately define what comes tomorrow and the day after. And we'll talk a lot about that over the coming daily market rundowns in the days ahead. Okay, now what gives me a little bit of confidence that this bounce is in play, that we're calling this turnaround Tuesday? Well, a lot comes from the bonds. Okay, if this was recessionary pricing, I can tell you right now the 2-year bonds would have far exceeded last week's low. Okay, we tested last week's low, we've bounced off it since. Right, the fact that ultimately the 2 years couldn't even extend last week's low whilst the S&P was down 2.7, the Nasdaq was down 4, tells me this is nothing more than a corrective flush out of some of the aggressive longs. Okay, moreover, look at the rates markets, guys. We're only pricing in 75 basis points of cuts this year. Fed told us in their dot plot projection 2, market thinks 3, not exactly a recession pricing going on. Okay, so don't get stuck in this recessionary mindset because you'll get your ass handed to if you're going to be aggressively shorting the risk markets. Okay, sure, that can change. One data point can shift it all. One negative non-farm payrolls data can change the landscape, but we don't have non-farms for at least another month. Okay, so rates markets not quite pointing towards a recession, rather pointing to perhaps a little bit of a slowdown in the growth expectations that economists forecast at the start of the year. Now, turning our attention to VIX, this is the one to watch. Okay, we spoke about this over the course of the last 2 weeks. What you can see is we have not had a single daily close below a previous day's low. We call this one-time framing. If we cannot close below a previous day's low, what it signals to us is this is probably going to keep stepping its way higher and higher. Now, When do we want to be buying risk markets? When do we want to be confident that we can start fading the move? Well, as soon as you break this pattern, the one-time framing in the VIX, well, ding, 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 you can be bullish equity markets then. Until then, you have to just be a cautious short-term buyer like me. You step in, you try and play for those little day-to-day moves, and ultimately you take what the market offers you. And right now, the S&P is offering you 40, 60, 80, 100 handles relatively easily because the VIX is sitting at 28, okay? Keep a close eye on this. Where we close, if we close below that 25s today, fine. Equities are going to be a very good buy for the next couple of days. Until that happens, we just have to stick with this time framing. One little point to note is that this is very unusual to see this sort of stepwise price action in the VIX, and it does typically suggest that VIX is going to stay elevated for some time longer. Okay, this doesn't just resolve itself. The VIX doesn't just roll over. It typically needs some form of an event where it either just has a massive move up as a result of just everyone giving up and absolute fear in the market, or ultimately what we get is something positive comes out, like a really good data point, or something that the market says, hang on a sec, it's time now, or at least it's time to start squashing this VIX back down because we've got a little bit more certainty. Okay, so if Trump was to announce exactly what he wants to do, Canada, Mexico, what you could well see is that the VIX initially pops higher but then gets absolutely squashed down because now there is a degree of certainty coming from knowing what we do know. Okay, now let's talk about data point today because this is going to give quite a lot of focus from the markets, and it's Jolts. Okay, Jolts is very much a forward-looking data point, and given this sort of thesis of a confirmed slowdown, not a recession, a slowdown, this will play a role in today's price action. Okay. Jolts, as you can see on a trend, so if you look at the purple line, it has been slowing for a long time. Okay, so the downward trend is not necessarily the concern, it's the speed. Okay, and that's why we've got this absolute bar chart at the bottom. What you can see is this is effectively a change month over month, and the biggest change month over month that we've had in the last 2 years is around 500,000-600,000 drop off. Okay, now on average, long term, big picture, around 7 million jobs is ultimately a balanced market in terms of private hiring. Okay, so right now you can see we're still very much above 7 million. Okay, so we're still somewhat tight in the labor market. And this is why Jerome Powell says we're tight in the labor market. We're not concerned about the labor market. However, should we get back below that 7 million today? Okay, I think that would scare the markets. We're expecting a 7.6 million Jolts number today. I think anything less than 7 million, be careful. Okay, sentiment is low. Sentiment is concerning. And like I said, yes, I've got a thesis today that is turnaround Tuesday, and that is my primary plan. That's what I'm playing for. But if we get a number below 7 million, okay, you've got to be very cautious because then fine, those fears are just going to be elevated. There's going to be a whole number of institutions that are looking at this going, OMG, what do I do? And in those sorts of conditions, my job is not to try and be a smart ass. My job is ultimately to trade what I see. Okay, sub 7 million, be careful. Okay, that does open the door perhaps to another sell-off today. But anything in that range of 7.4 to 7.6, I think the market will take it in its stride that things are okay. And any number above 7.6, guess what? It just confirms a bit more of the relief rally. Okay, it will sort of make the turnaround Tuesday go on steroids. All right, so that is the place for today. That is the opportunity scope for today. There's a number of things going on, and it's important that, like I said, you've just got to pay attention to what price is doing. Have your thesis, have your hypothesis, take your trades, make sure you're always managing that risk. Okay, in these conditions, there's a lot of work to do, but you need to just make sure that you're always safeguarding yourself. That being said, good luck out there today. If there are any questions, do post them into the private Discord channels. Otherwise, like always, manage that risk. Good luck. Go make some money.